A whopping 142 lakh people in India started investing for the first time after the pandemic in financial year 2021, out of which majority were millennials aged between 24 to 39. And being a new investor, we often make a lot of poor decisions and end up losing our money. And many of us even get disheartened after a loss and quit investing forever. Well, as they say, we should learn from others' mistakes. So in this video, we'll talk about 5 such common mistakes that investors make, especially in the beginning of their investing journey. But before we get into it, make sure you subscribe to the Money Control channel. Number 1. Staying in the comfort zone. When it comes to savings and investments, the first thing that comes into our mind is a fixed deposit. We come from a society where investments like fixed deposit, gold, real estate are given more priority as these investments are regarded as safe. Well, if you only invest in FD and real estate, you'll miss out on the growth opportunities that equity investments has to offer. So make sure you have a well-diversified portfolio with a fair amount of equity exposure. Number 2. Lack of patience. One of the most crucial mistakes that almost every new investors make is being impatient with their investments. Frequently checking account balances, reacting to short-term volatility, abandoning long-term investment plans are some of the poor investment behaviors that impact our wealth creation opportunities. So, keep your expectations realistic with regard to the timeline for portfolio growth and returns. You can also invest using SIP investment method so as to avoid making poor decisions. Number 3. Letting your emotions rule. A lot of new investors tend to go with the going trends or often end up investing using suggestions. For example, making investments in the crypto when crypto is in trend, or investing in equities when markets are gripped by the bulls. At every point of time, different assets perform differently. So avoid making investments out of emotions or suggestions, or else you will end up making heavy losses. Number 4. Investing money that you might need. Before starting your investing journey, you should have a control on how you spend your money. A big part of that is building a cash reserve so you don't need to rely on investments when you run into an emergency or want to make a certain purchase. The stock market can be volatile and you'd hate to lose the money you were saving for something like a down payment on a home. So make sure you have enough savings or an adequate emergency fund balance before you start investing in stocks. And number 5. Neglecting to start or continue. Many people often fail to begin an investing program simply because they lack basic knowledge of where and how to start. Likewise, periods of inactivity are frequently the result of discouragement over previous investment losses. Investment management is a discipline that is not overly complex, but it requires continual efforts and analysis in order to be successful. Lastly, first-time investors should begin with emergency funds and purchasing insurances. And when you start investing, stick to simple index investing or seek professional help to build suitable portfolio. So, don't let discouragement stop you and share this video with your friends. Subscribe to the Money Control channel for more such videos.